Hey, good morning, everyone. I'm doing an update. I want to talk big picture, but before I do that, just it's 7:45 here, Tuesday morning. So there's a big gap here that I think the market wants to back and fill. I think it's going to be pretty key whether or not the bulls can get it above there. This is the Russell. So I'm a little bit short equities, a little bit offsides. I bought some tens. I kind of broke down. I kind of have to flip and play ultras a little bit short against my tens and thirties. But my guys kind of know what we're doing. But this is key. I mean, oil's trying to go for it along a little bit of the Nasdaq. We'll see if we can punch through these 30-minute highs and then go for that gap or not. Decent amount of numbers here this morning also. So keep an eye on that. And then big picture. Sorry, I think I had the wrong screen up. Here, this is the gap on the Russell I was talking about. Here it is on the Nasdaq. These are the lower highest. You get through here, then we could go for this gap. You can see it's pretty prevalent. I mean, oil's trying to get above the bands here. Gold, I think, can come back down to pi. I'm a little bit short that against my my short Russell and tens that I bought. Here's ultras breaking down. But back to the big picture chart I wanted to talk about. All right, global macro, everything's connected. But as you follow the forex markets, the dollar, the euro, the yen, how it relates to commodities, gold, oil, bonds, equities, everything's very much connected. So you start to get a feel for when something changes as a phase transition, big picture in a particular market. And over the years, you'll get to see sometimes the euro and dollar will change first, then sometimes it's oil. But when they all start to move and sync up together, you can feel that more confident that there's a bigger synchronized um, global macro move coming. And so I just want to kind of step back on these weekly charts to put some things in perspective. We've had a great start to the year and the month already. We came in long bonds and gold for reasons I'm going to show you in a second. Been short the euro, long the dollar. A lot of people have been kind of dollar bearish, thinking the too focused on the Fed, even though they might have had equities coming off the top. We've talked about the big picture turning point on the economic confidence model was in January, and equities peaked exactly with that, which is major correlation, and we'll see if that's going to hold true. So far, on a daily level, it was spot on. Weekly level, it was spot on. And then if we get a monthly turn, that could be a serious long-term timing turning point back to the downside for equities, maybe for 2 years into the next turning point, which is 2022. So I kind of think that's a very high probable setup. It doesn't mean you just blindly short equities. We're obviously going to risk manage it along the way. So there's been several big calls, and I want to just show. I like to start with the dollar because if you get the dollar right, you'll get a lot of other things right. So 2014 is when the dollar really started its new bull market. When you put this in perspective, the way we view things, it's actually pretty obvious and easy. So the way I teach it, there's a lot we analyze around the trend, what we call the bands. But all this broke down 2002, 2003. We had a bear market in the dollar. That all changed here 2014. First, when you got above here, and then it was definitely obvious when you got above here. And then we've been in this bull market ever since. So I think it's people get lost in the intermediate term and so short-term focused. This was a test. This was a test for the dollar right here. We had a pretty good call though. It was concerning that we didn't hold this low from 2017, and then we broke the bands. Well, you had the 200 here, which a lot of traders use. But then I'll show you on the weekly level is a concept called our pie line that held exactly. So we were actually long and then added and got really short euros. And this has been a good call. So this is still the uptrend that's clearly in place. Even if you were to come back to 93, 92, I mean, you're doing nothing but putting in a series of long-term higher lows. So still very much a long-term dollar bull. I think the big 5-10 year call is another acceleration, another move in the dollar that's going to break the back of the monetary system, and then you're going to have a massive dollar sell-off. It's dollar up first. We'll see. Now, when I go to the weekly, so remember that 2014 is when you started that move up, and then the last kind of bounce and pivot was here at the beginning of 2018. When you go to the weekly chart, this is again the dollar index. Euros is obviously the inverse, right? What was I gonna say? So here, this was the start of this massive move up. You can see this is the weekly chart on the right here. Oil. That's what broke oil down. You move the dollar that much. Good night. Oil petered out, started to break technically, and there's no way oil could sustain that dollar move. Plus, we were starting to move. We're starting to cycle off a little bit, 15, 16 as far as growth. But this pie line here, this dashed red line is where essentially I was saying that we were basing, and then we started the new rally right here. So that was our euro short dollar call, and it hasn't changed. We've still been dollar bulls. You kind of had to manage this pullback, but look, every time we've gotten to what we call the bands here, you've got nothing but higher lows. This yellow line I'll throw in here is the 50-day. And because so many traders use it, but again, if you're using moving averages and you want to be bullish because you're above it or below it, it's just a silly, goofy. It doesn't work, guys. And you're gonna get. What are you gonna be? You're gonna be short, long, short, long, short, long, short. Really bearish. I mean, you're getting bearish right where the market was holding. So I cared more about this higher low, the 200 here, this whole area. So technically it doesn't, I'm not surprised a lot of people got twisted up. Now, when you look at the euro, you can see you actually failed right at pi, this last move up, which was really helpful. So I've been core short. This has been a great call for us this morning. I'm booking more gains, but I'm still going to ride a core short. I don't see why there's any reason to think you can't get back to 108, 109. And then if that breaks, you can talk about a serious big picture move up in the dollar. So this is still very much in play. Nothing's changed to make this bullish in our model, and it's been the right call. Now, okay, so I hit on that dollar and what it did to oil. The dollar will also be very bullish when you have growth slowing and you have deflation, or some people want to categorize it as disinflation. You're arguing about the same thing. It's rate of change. You're decelerating as far as inflation. When you have that, when you have growth coming down, both of those, I just call it deflation all around. Growth slowing, deflation. Inflation's coming down, deflation. That's when you get the biggest moves down in equities. You get the biggest move up in the dollar. Sometimes even commodities like gold won't even go up, but most of the other commodities go down. So we'll see what happens to like the CRB, the rest of the space, but energy for sure. This was our trend line down on oil. It's been in place since the highs of 2013, 14. Commodities peaked with the ECM in 2011. This was the dollar move. It broke oil hard. I've got drawn on here the standard deviation. So this line was 1 standard deviation. This was 2. So most recently, we just failed up at 1 standard deviation. 2018, we just did it again here to start the year. And that also coincides with that downtrend line. So this is showing you the long-term deflationary move I'm talking about. And then occasionally when we have these big drops in the stock market, the Russell collapsed 28% when Powell panicked. The Fed went back dovish. We kind of had a reflationary bounce. With the same thing happened here in May. Every time we have an equity sell-off. Now, whether or not the Fed's going to be able to keep reflating this, the worse the economy continues to get, at some point that's not going to work, and the reflation won't come. But that said, this is the key. We ran that reflationary bounce into the long-term trend. I think there's a better chance that the long-term trend is going to resume. So we definitely want to be a seller on a bounce. We were kind of long into this move to see if we were going to get a higher low. We didn't get it. We said buy puts, cut risk. Now we've caught this on the short side a little bit intraday. And any type of rally with this daily cycle, we want to short into oil. All right. And then big picture, if you break 50, there's plenty of reasons to think you'll go back to the low 40s. And then big picture, if you don't hold 40s, you got to talk about the lows down here at 26 from 2016. Now that'll coincide with most likely a dollar breakout above 99.100, and or stocks really just cratering and global demand, blah blah blah. Right? Big levels in oil. We talked about. I mean, we called it. We get up here 62, 65. Maybe that was the peak. And this reflationary bounce. Maybe oil is going to be the first to change direction and signal more of a deflationary move. That's exactly what happened. So that's pretty clear. The only other thing I wanted to highlight was the Russell and equities. We haven't pulled the trigger on our call to short S&Ps, the Dow, big picture, or the NASDAQ. We're still in a bullish trend there in our model longer term, but we are short the Russell longer term. And so GDP, the cycle, U.S. economic cycle peaked September, October 2018. That's when you had the big down move here, especially small caps get rocked. That 28% correction I was talking about. And then really had nothing but lower highs until this last push. And I think the street is chasing equities a little bit. There's a nice long position as far as small caps in the Russell, which I'm happy to be on the other side of. So that's the game plan there. I think this is going to be another long-term lower high, and we're going to be back at levels that we were at in December 2018. But you can see, I mean, there's still some intermediate term work we have to do on the downside. So keep selling rallies. We got to cover some stuff really well Friday and yesterday, and then now we're sitting through let me sell some long bonds. We're sitting through another just kind of a dead cat risk off bounce. I think we were going to fill that gap. We're getting pretty close. So this is the near term. But anyway, I will go back to the short side on my core positions on the gap. And then, of course, I'd get heavier here into PI in the 200. So anyway, guys, join our chat if you're not familiar with how to do that. I'm going to post this on my website where it'll be really easy for you guys to pick up the free ebook, and then you'll kind of be in the right spot to join the chat. But you can always go to Jenkins CM. JenkinsCM.com and put your email in. It's free to join our chat room, but I'll invite you in. Usually get around to that in the evenings. I'm going to be putting out some more analysis or ebook about cycles and time, how we trade. We have some memberships courses. I get into that another point. Thursday we'll be doing a webinar. You can sign up for that as well. I'm just going to be talking global macro, Q&A, whatever you guys are interested in. I mean, from crypto to the bond market. But that's good. I can go over some of our strategies and our cycle work. So it'll be just open, kind of laid back session. But anyway, I hope you guys have a great morning. I'm going to jump on my team. And yeah, have a great rest of your trading day.